So what's a wheel strategy? And this is a common word among the lingo of option investors or option traders. So the way wheeling works is, first step is a share acquisition. I am bullish about a share. I want to have those shares in my portfolio. We got two choices. One is go ahead and buy the share upfront from the market, or you can sell a cash secured put at whatever strike price you're okay to buy the shares. If you're okay to buy the shares at current price, sell and add the money cash secured put. If you want to buy the shares at lower than the market price, go and sell a put at a strike price which is lower than the market price. Whatever price at which you are okay to hold those shares. So first is that's a share acquisition step. When we talked about cash secured put, I mentioned this is if you're moving from stock, purely a stock investor, to an options, maybe use this cash secured put as your share acquisition step. So in your wheel strategy, that's your number one step. So you go ahead and sell a cash secured put. What could happen? Put may not be assigned, means the stock did not go below your strike price. In that case, you will not be assigned the shares, but you had retained the premium. So when you sell that cash, when you sell the put, you get a premium upfront. We had a question in the quiz that if you sell a put at 45, you got a premium of $3. Now at expiration, the stock is still above 45. So you will not get the shares. So that put will not be assigned to you. In that case, you will still retain those $300. Those are yours to keep. If that happens, repeat the step. So you can keep selling a put for every expiration. Say if you are sold it for January 2021 monthly expiration, and on January 15th, the stock is still above 45, don't get assigned, go ahead and on next trading day, go ahead and sell it for February. Okay. So if your put doesn't get assigned, keep retaining the premium and keep repeating the step. If your put get assigned, then you have to buy the shares at the strike price. Let's say the question get an example of 45. So in those cases, you will have shares in your portfolio at $45. You have to buy those at $45. So now what do? You got a shares in your portfolio, you acquired the shares. Now you have to look at, okay, I want to sell those shares. Either you can sell it at a market price right now, or you can put a limit price which is a little higher than market price because you want to sell it a little higher than the market price. But then you don't get paid for waiting. Or you can sell a covered call. So the step 2 of this wheel is go ahead and sell a covered call. Now coming back to our example, you sold a put at 45, January didn't get assigned, you retained the premium. You sold a put for February, didn't get assigned, you retained the premium. Then you sold a put for March expiration, so you got assigned. Now you have 100 shares of that XYZ stock in your portfolio. Now you go ahead and sell a call against those shares. That's why it becomes covered call. You go and sell a call against those shares for April expiration. What could happen in April? Your call may not be assigned because the shares never went above your strike price. So you still retain the shares in your portfolio, and you also retain the premium that you collected when you sold the call. So you still have the shares and you also have the premium. So essentially, you got paid for waiting for stock to go beyond your price, which is your strike price at expiration. So if call is not assigned in April, you repeat it because you still have the stocks or the shares in your portfolio and you got the premium which brought down your cost basis. You repeat the step. Do it for May month. Do it for June month. Say if your call get assigned in June, in that case, the shares will be taken away from you at the strike price. So now your portfolio does not have any shares. So you had XYZ shares because you were assigned those shares. Now in June, the covered call got assigned. So those shares, XYZ shares, 100 shares of XYZ has been taken away from you. Your portfolio have 0 shares of XYZ now. Now you can think, are you still bullish on the stock and you want to get engaged in the stock or not? So if you're not bullish on the stock, you don't want to acquire the stock again, stop right here. Or find another stock, find ABC stock. But if you are still bullish on the stock and continue want to play this, just rinse and repeat the same process. Now this is one variation of a very basic variation of wheeling. Now as you get more experienced, or if you are more bullish on it, you can make changes to some of those steps. For example, if I am really very bullish on XYZ and I want to acquire 200 shares, but I might sell just one cash secured put here. Once I get shares assigned, I might sell a put as well as a call here, essentially strangle, right? So there are variations that you can do, but this is a very basic wheeling process. And you will see me talking about, hey, if I get a shares, I'm going to wheel it to reduce my cost basis until it gets called away. And then I'll see if I'm still interested in it. I'll rinse and repeat the same process. So this is in a nutshell what's termed as a wheel strategy. Again, this is not an official term. So you may not see it in any books if you're looking at option trading strategies, but this is pretty common way. I see many option traders using it to get a share and then continue collect a premium until it's called away. If it's called away, still bullish on it, rinse and repeat. Right.